Welcome back to the Shitcoin.com show, everyone. Our guest this week is Kevin Zhou from Galois Capital. I'm pronouncing that right. I did my research before this to double check. There we go.
One of you.
How are things, Kevin? How are you doing?
Doing great. Happy to be on the show, and interested in having a chat with you guys.
Definitely. So you and Andreas, you've known each other a while, right? You go back in the in crypto years, I guess, and you know each other from IRL, so I believe.
Yeah. We were both working at Kraken quite a while ago. Kevin was running the trading desk. I was programming and socializing around the office, and it was a pretty good time.
Mm-hmm.
And I forgot to say we were roommates as well. I also cleaned all of Kevin's dishes.
Oh, did you know? It's not like that. I don't remember any of that. I don't recall how it used to be in that house. But I think it was a fun time. We were living with two other guys, and it was the four of us living in this house. Yeah, so it was a fun time.
Nice. So, Kevin, with the, I guess I wanted to ask you about this just to dive into it. Seeing as though you work, you're a co-founder of Galois Capital. So there's been a lot of talk lately of traditional finance and traditional funds wanting to get into crypto, but you guys have been in the space for a while now. Do you think traditional firms are going to be able to compete? And how do you see that playing out when people have got such deep knowledge in the space?
Mm-hmm. I think that's a great question. I think just to start, we're definitely seeing a bunch of institutions start coming in, and I think largely that's due to folks like Stanley Druckenmiller, Paul Tudor Jones, Ray Dalio. All these guys have started saying good things about crypto, and that kind of removes the career risk for a lot of other emerging managers or capital allocators to come into the space, and obviously helps with MicroStrategy with Elon too, coming in with Tesla. So a lot of these folks are coming in. Whether or not they're going to be able to compete, I think it really depends on what vertical we're talking about, right? So if we're talking about like on the VC side, certainly very top name VCs, I think would be able to compete with crypto native VC firms in that they already have a brand built up from like the tech days, that sort of thing. I think more middling sort of branded VCs, I think they'll have a harder time because it is at this point a little bit of an old boys network, and getting deal flow is a little bit difficult, and to really be immersed in the space provides a huge advantage, I think, on that side. And I think on top of that, there's also questions about judgment, both in the short and long term, about how exactly to invest into what kinds of tokens, how exactly do these technologies work. So, I think the crypto native guys have some advantage, but depending on the VC, they might be able to compete. I think on the sort of like a more macro side, I mean, if you're investing for the long term, you're running some kind of fund in the traditional space. I think those guys, they have access to a different pool of limited partners or investors than some of these crypto guys do. Generally they're a little bit more suit and tie, a little bit more buttoned up, and they have access to huge amounts of capital. So I think on the raising front, they probably won't have too much problem. Now, on the investing side, I don't think they need to do anything fancy. I think in the beginning, a lot of these LPs are just looking for some kind of exposure, maybe alpha on top of a little bit of exposure to crypto. So I think, they'll do a fine enough job on that. Now, if we're going to get into like the nuances of how to do like yield farming, or like, how to invest into NFTs, or how to invest into like these DeFi protocols, I think for that, probably the crypto native guys still hold some competitive advantage, and it'll take some time to build up that kind of institutional and that kind of like tacit knowledge for these latecomers to adapt. Now, on the trading side, I would say that it's a bit of a mix. So if you look at, some of these prop shops who have been doing, like, let's say, high frequency trading and market making for a while, some of the Chicago boys like, Jump, Tower, HRT, all these guys, and, all these guys are already in crypto. But, folks like them, as they come into the space, I think they generally have an easier time adapting. I think for the most part, the general principles of market making hold across all different types of markets, all different types of asset classes. They've already built up very heavy duty infrastructure. Their internal speeds, their tick to trade on their trading systems are very fast. So they have all that down. Now, that being said, maybe their crypto knowledge is not as advanced as, some of the more crypto native folks. But I think, we've seen that at least with Jump, and I think they're one of the, earlier prop shops to move. They've been very quick to adapt to DeFi. They're part of the DeFi Alliance. I know they've been doing some market making on Serum. And then I think maybe less publicly known, maybe just some rumors. I've heard some things about, they've been tracing some sandwiching attacks back to those guys. And those are reasonably sophisticated. I mean, it's not rocket science, but it's still reasonably sophisticated, for a firm who's not native to crypto to employ. Though I think at this point, it's fair to call them fairly native. I mean, they've been around for a very long time. And then I think outside of that, I think custody and security always remains, foremost in a lot of people's minds. And I think with a lot of these institutional guides, they have to get around how do they secure their crypto properly, right? On one hand, they can use crypto native custodians, either Gen 1 or Gen 2, right? So Gen 1 being like BitGo, Anchorage, Coinbase, and then Gen 2 being like Fireblocks or, Copper. So they could use that, or they can build their own. I think if the entity is large enough, right, like Fidelity, it seems like they would have to build their own. Otherwise, it's just, people trust the Fidelity brand, and I think it makes them look a little bit uncompetitive if they're not able to build it out natively themselves. So it's almost like from a branding perspective, from a business perspective, they can't really be using some other third-party service. But I think for maybe some of the smaller guys, as they develop more trust from some of these crypto native custodians, I think they'd be happy to use them, or they can just use Fidelity service, something like that. I think with custody, there's always a challenge with sort of old school, financial institutions coming in, because, a lot of these institutions are very monolithic with a lot of different levels in the hierarchy. And it makes it hard to, develop a custody solution, because the sort of low level engineer who's actually implementing these things is so far removed from the incentives at the very top with the shareholders and, CEO and whatnot, that it makes it hard to cross that divide, right? So, incentives are not the most aligned. I mean, the guy, he's not going to see that much upside to implementing it, 100%. Maybe he'll just do a 99% job, but then, the higher management understands that. So they got to be extra strict about it. So then, then it just takes forever to get the product out because there's so much at stake. It's just a lot of the problems of the calcification in the culture of a big company that come into play here, which is why I think, that stuff will be very slow to develop. In the end, it'll probably be fairly safe, because I don't think they'd release a product onto the market, ruin their entire brand for, some new side hustle, which would be crypto, but it'll take a really, really long time, I think, to build out. So as opposed to maybe some crypto native security or custodian solution where, they don't have anything to protect or lose anyway, right? So they can come out with stuff a little bit quicker. I think that was a lot, but there was just some.
Yeah, I gotta follow up. So you and I were actually talking about this many, many years ago about traditional finance trying to get into the space, and especially from the context of, I believe at Kraken, at some point you were trying to maybe hire people from traditional finance, and it is tough because, for us, you just always assume that everything is hacked and fucked and your money is gone, and the exchange will just rug pull you, or regulatory just disappear, like any of this stuff. For us, that's just another day of work. You just assume that your money's going to be stolen. That's your default setting. And then over time, maybe you build a little bit of trust. So that's kind of the counterparty risk. But also for us, it's normal that that Binance or Bitfinex, whatever, just says, oh, this trading pair is offline, or we're doing emergency maintenance in 1 minute for a week, or just like anything, or extreme delay in placing orders, or the inability to cancel orders, just any of this, or you can't get your money out for a while, your deposit is not getting detected. But all these things for us are just normal. But if you're coming from traditional finance, how are you supposed to change the way your mind works from everything always works, and when it doesn't, I call somebody to a lot of things do not work at all, and there's no one to call. And especially, there's no one to call unless you've been building a network for a long time.
Yeah, I definitely agree. Sometimes there is nobody to call, and sometimes you just got to chew a lot of glass. And sometimes there's ghost changes on the API with no documentation.
Mm-hmm.
There's maintenance and downtime randomly. There are times where you literally see bugs in the matching engine. I've seen bugs in the matching engine in some of these exchanges, non-deterministic behavior in some of these matching engines. So it's same thing happens, two different outcomes. So like really crazy things. Like that. I've seen I've seen orders vanish in front of me as I go out to reach them and go out to hit them. I was just like, it's endless basically. Right. And this is, I think partly where the alpha comes from, is just the willingness to deal with this kind of pain. And I think if it was super simple and everything was super fast, well then, it'd be very much dominated by a lot of the traditional players. Right. And that's kind of their game and what they're used to. And I think in some ways, because of the slow development of infrastructure in the space, it's actually been beneficial for a lot of crypto native folks because they have some kind of insulated time to go and catch up to the major players. Now, in terms of capital, it'll take a really long time, I think, to catch up to how well funded some of these guys are, with their very deep pockets. But I think on the info side, maybe what they did and what they sort of discovered in the past 2 decades maybe could be covered in like 7 years, 6 years, something like that. So yeah, I mean, it's a little bit different. And I find it interesting. A lot of times when we hire folks, you could hire folks on the crypto side, you could hire folks more from the traditional side. And I think each one brings its own perspective. Each one has its own strengths and weaknesses, right? And one thing that always stood out to me a little bit is that sort of the traditional guys, they don't know how bad things are, and they don't understand just kind of how to sometimes you just got to shoot from the hip, because literally, things change so fast. You don't even have time to build out an extremely robust solution. You got to just get something that works, and hopefully the alpha lasts, for a couple months, and then move on to the next thing. And then I think with the other folks, with the crypto native folks, sometimes it's hard to kind of teach them sort of like the history of finance industry, financial institutions, and sort of why things kind of develop the way that they are. Now, some things I think we can definitely improve upon, right, and we can do it better this time around in this kind of like parallel financial structure. But still there were some reasons why exchanges went to like a hub and spoke model. Why why there's like transfer agents, why there's clearing houses. Like we're kind of rediscovering these reasons too, right? So we're kind of reinventing the wheel. So I think the second time around the wheel is better, but also there are some reasons why the wheel is round and it's not square.
Oh yeah. So you're saying there's a reason why the exchange clearinghouse, custodian, and exchange is not like one dude in his mom's basement.
Yeah. There's definitely good reasons for stuff like that. Yeah, there's definitely good reasons. And if you think about it, way back in the day, in the very early days of finance, I mean, there was a lot of these pieces that were non-existent, right? There were no clearinghouses in the super early days, and then slowly over time, these developed out of necessity. And it wasn't just because people wanted to overcomplicate things, right? But over time, that's just how it happened. Now maybe we're in some kind of local maximum and not like a global maximum. We got trapped there, right? Because that's kind of how things have been done, and we've just been settled into there. And there's ways of breaking out, but we should understand the context of history and why things had happened the way that they did. Yeah.
Kevin, I wanted to ask you as well. So I was checking out some of your recent interviews and heard you talking about Galois looking at yield farming and having some fun with that. Obviously, during like DeFi summer of 2020, everyone was a yield farmer. Do you think that now it's just turned into a whales game, or how do you see that progressing on the yield farming side of things? How do you see it looking in the next year or so?
Yeah, I think that's definitely a great point. I think for the most part, with the exception of certain projects that are trying to get around this whale problem, it pretty much is a whale's game. And, just to point some out, like, for example, Yearn and Wi-Fi, this whole ecosystem is all about individuals pooling their capital together, maybe paying 1 times the gas fee, right? And then using these big chunks of capital in these pools, having some kind of automated yield strategy. So they don't have to pay, gas every single time they want to do crop rotation on their single, $1,000, farm. So now you pull everything together, you save on transaction costs, and you don't have to manage it, right? So it's a nice way for people to kind of like democratize this kind of like robo advisoring or this yield farming, these kinds of yield farming strategies. And they're starting to get pretty complicated. Like if you look at like things like Alchemix, you look at like the Iron Bank, all these different ways of doing it. It's starting to get pretty meta at some point, and very, very composed, many contracts down the stack. But outside of, I think, that ecosystem, generally it has been a whale's game. And, I think this is traditionally the CryptoKitties problem, and a problem I think me and you, Andreas, we've talked about for many years before that, which is that, you have so many different apps on Ethereum which compete for consumption of gas. And at the end of the day, those users who are for a particular use case, which have the highest propensity to pay, are going to start dominating other types of use cases. And it could be like a day by day kind of thing, right? Like today it could be protein folding that uses up all the gas and nobody else can do anything. Tomorrow it could be like this, the sports betting for this, Super Bowl or something like that. Next day could be another thing. So it has a lot of this kind of stop and go, function. Issue, right? And that's what we're trying to solve with the scaling. Yeah.
And on that one, Kevin, I mean, we talked about this many years ago. I don't even know when. I don't know if it was from you or if it was from Barry Silbert. It was somebody else as well who said Ethereum will be dominated by basically one application. But the nasty part is that one application will be whatever is making somebody more money. So the natural one is gambling, because gambling is extremely high margin. Mm-hmm. So you will end up with probably your chain being dominated by the worst use case, like scams.
Yes. Yeah, definitely something like that. It's basically, I agree. I think it's basically wherever the user has the highest propensity to pay, right? So like if to use one kind of product, they're willing to pay like $1,000 per use, then, they're just going to dominate the chain compared to people who are only willing to pay $100 per use, right? So it all just comes down to like the gas schedule, how many function calls there are to the EVM, and then what the actual cost of gas is, right? And then you just sum total what the marginal willingness to pay for each use case is. And the higher ones are going to start dominating. It seems that right now, it's exactly like you said, which is about making money. But I think it's actually less about gambling and more about like arbitrage, right? Like you look at like who's actually consuming tons of gas. Like Alameda's consuming tons of gas, and they're probably arbing all the dexes, right? Because like they do it such that every time they actually do a transaction, it is profitable, considering what the gas cost is. So it's just like always going to be profitable, basically, right? Yeah. Sorry about that. Yeah. So basically just by the nature of the activity, the fact that it went through means that it was profitable, right? So like they're only going to do it when that's the case. So yeah, that's been consuming up a lot of gas. Now, I think a lot of people are saying, okay, well, maybe there's other ways of, with scaling, with sharding, with proof of stake, a lot of this will be resolved with L2, roll-ups, that sort of thing. We'll see. Yeah, maybe it will, maybe it won't. One argument could be that electricity is used for a whole bunch of different things, right? So, why is it that, one use of electricity is not pricing out another? Well, I mean, technically it is, but basically the base cost is so low that it's still profitable to use it for so many different activities. So if the cost can be driven to that low as an analogy, then maybe things are still possible. Maybe multifunctional kind of chain is possible. But I think a lot of that comes down to scaling, which is why they're trying so hard. And they've been trying for many, many years. The other alternative that some people are saying is that maybe there's going to be, these more, these higher throughput chains like Solana, like BSC, stuff like that, right? And, I think my thought there is that I think generally, if there are easy ways to gain throughput without giving up decentralization, Ethereum probably would have already done it. Or if they haven't and they weren't able to figure that out, and Solana actually does work, then I don't see why they can't just copy Solana, right? Now, a lot of that just comes down to like which side has more apps, which side has more network effects and has built out a moat. But that being said, Ethereum just being so early, it's built out, quite a bit of that. So, it doesn't. They have some time to copy and still be in the lead, in my opinion, if that ends up being the case. And then there's also the question of, centralization, and maybe there is a case where some of these kinds of apps don't require decentralization, right? Like, for example, with a peg stablecoin like USDC, I mean, it's already pretty much centralized on the minting and redeeming process anyway, right? So like any further centralization is not that much more damaging, right? It's only marginally damaging to decentralization. But, for the most part, it's not a very big gap, right? Like something that's mostly centralized versus something that's slightly more than mostly centralized, I mean, it is not that big of a difference, right? So maybe for coins like that could be issued on some of these more centralized chains, and it should be okay, right? Now, there's also questions about like, how do you port over, across all of these like cross-chain bridges, to make sure that you can use apps across different chains, right? And then now you run into like some similar problems where if you start wrapping like BSC type tokens onto ETH, and then you want to move them around in ETH, you still have to pay the ETH gas costs, right? So like there's still just like it's like BSC style USDC, and then you wrap them to ETH, and then now you still got to pay gas to move that around, right? So there's all sorts of questions there. So still left unanswered. We'll see how it plays out, but. Yeah, I don't want to give my opinion too much there. Yeah.
Yeah, fair. I actually used one of those like Tridex things, and it basically, the fees are insane because it was saying that you could basically switch between blockchains, but you realize that that's not the case, is it? There's still got to be the fees being paid. So yeah, not as great as it's marketed. The marketing is very good, but not quite there yet, product wise.
We'll believe it when we see it. We've been hearing about these pie in the sky, field of dreams type things, especially 2017. I think a little bit better this time around. For a while now, so we'll believe it. Me and Andreas have been in the space for so long, we just assumed that everything is a scam. we've seen things come and go. Like Megacoin wasn't even that bad of an idea, but what's Megacoin? Where is that even today? Does that even still exist? Shit like
I mean, or like one coin where there's only one. It's divisible, but there's one. So it's like a comma thing.
Oh yeah, there's the 42 coin. There was one where there's only 42 coins. I think if you remember that
one. But yeah, like most, and it's true. Like, where is Gnosis? Where is Augur? But we already knew this, and. I think the same will probably be true for like Tron. Eventually, there will be no Tron. And most likely, eventually, there will also be no Binance Smart Chain. This is just how it is.
Here's the thing, Andreas. Just on a publicly broadcast a podcast, I just don't comment on stuff like that. It's just there's in polite company. At dinner parties, I just don't talk about three things. I just don't talk about religion, politics, and then L1. And L1. We just don't talk about the L1. We just never talk about L1.
So okay,
I will not take that advice from you because of Shikra.com.
Yeah,
but I guess I don't need favors as bad as you do.
Oh well, you know how it is. You got the FCU money. You got the FCU money. I'm still in the space. I still got to do business with everybody. So got to be diplomatic over here. Yeah.
Well, so okay, Kevin, if you can't, I understand you don't want to name and shame, but for people that are newer to the space, what should they be doing apart from just insane amounts of research to make sure they don't get rugged? What is the traders' verdict?
I think doing insane amounts of research is great. I will say this though, just to clarify a little bit and to maybe qualify that statement, which is that there are times where some of these new yield farming protocols, in the first day or the first few hours, the yields are absolutely insane because nobody's had time to truly vet out the protocol. So you really have to think about it as a reward, a risk versus reward kind of bet. Maybe by the time the smart contract audit comes out, the yields have already dropped by, two decimal places, right? So, I think if you're able to vet out the code yourself, if you can get in early while still having a good balance of doing your own diligence, I think that's probably most optimal. If you're not doing it as a full-time job, then I would say just wait. Then you should really do a lot of research, and you should wait until it's a lot safer. I'd also say that don't be too greedy. I think it's very easy to see things mooning like Cardano and just think that I'm feeling the FOMO. I got to hop on this train. And nothing against Cardano. Maybe it's great. I talk about there, right? But
love Charles, love him.
I just feel like you should be very careful. And I think you should look to the old heads. I think a little bit, not to pat ourselves on the back too much. But I think me and Andreas, we've been through enough to have seen people make and lose fortunes, right? And I think one thing I think you'll agree with me on is that generally the saying is true that bulls and bears make money, but pigs get slaughtered. So you got to be very careful that you're not being too emotional and you're feeling too greedy, and you really want those eye-watering 6-digit yields. I mean, if it's too good to be true, maybe it is. Maybe it's not. But if you miss out on it, it's okay. There's more opportunity. So maybe just to leave it with the ancient Sumerian saying, shitcoiner's gonna shit. So you don't want to be the one getting shit on. So.
Well, I think that rounds it up, and that's literally the best way we could end this.
Yeah.
I can't top that. So, Kevin, really appreciate your time. This has been great.
Thank you.
And guys, be sure to check out Galois Capital on Twitter. I'll leave the links anyway. I know that, you can check out what they're posting. I saw you guys are hiring. Definitely people should check that out. As are we at shitcoin.com. People should check that out too. So,
but it's easier. We'll take somebody like IQ 95. But unfortunately, to work for Kevin, you're gonna have a galaxy brain.
You don't want to be in the middle of the bell curve. That's what I learned.
Oh no, that's the worst. That's where you're doing research.
In the middle is the worst. Yeah.
Shift with side shift AI. Good job.